You're sitting in your living room. The year is 2008. The stock market is collapsing. Lehman Brothers just went bankrupt. Your retirement account has been cut in half. The news is calling it the worst financial crisis since the Great Depression. And you believe them because that's what everyone says. That's what the media repeats. That's what gets taught in schools. 2008 was the big one. The crash of our generation. The worst it could get, but here's what they're not telling you. 2008 wasn't even close to the worst. In fact, if you look at the history that's been buried, the crashes that have been forgotten, the financial disasters that almost no one talks about, 2008 looks like a practice run. There have been 4 crashes in American and global history that were so violent, so devastating, so total, that people who lived through them would have begged for 2008-level pain. Banks didn't just fail. Entire economies collapsed for decades. Markets didn't just drop 50%. They dropped 90% and stayed down for a generation. And the terrifying part, every single one of those crashes shares the exact same pattern that America is repeating right now. If this is the kind of information you wish someone had told you before 2008, before the last crash, before your portfolio got destroyed, then smash that like button and subscribe. Because this channel breaks down the financial history they don't teach, the crashes they don't talk about, and the patterns that reveal what's coming next. And what you're about to learn will change the way you see the economy forever. So why do most Americans only remember 2008? Simple. The media only covers what's recent. Schools don't teach financial history beyond a single chapter on the Great Depression, and our collective memory is short. We live in the now. We think whatever just happened is the biggest thing that ever happened. But the painful truth, the truth that Wall Street doesn't want you to know, is that 2008 wasn't unique. It wasn't unprecedented. It wasn't the worst. It was normal. It was what markets do when debt gets too high, when speculation runs wild, when everyone believes the good times will last forever. And it's happened before. Again and again. Worse than you can imagine. So let's pull back the curtain. Let's expose the 4 crashes that make 2008 look like a minor correction. And let's see if you recognize the warning signs that are flashing right now. Crash number 1. The Panic of 1873. The real Great Depression. Most Americans have never heard of this. It's not in the textbooks. It's not taught in schools. But if you lived through it, you would call it the worst economic disaster in American history. The year is 1873. America is booming. Railroads are being built across the country. Banks are lending like crazy. Investors are pouring money into infrastructure, into expansion, into the dream of manifest destiny. And then, in September, it all comes crashing down. A major investment bank, J. Cook & Company, collapses. It financed the Northern Pacific Railway, and the railway can't pay its debts. Panic spreads. Within days, the New York Stock Exchange shuts down. Not for hours, for 10 days. Banks across the country start failing. One after another. Small banks, big banks, regional banks. The entire financial system seizes up. Unemployment skyrockets. Within a year, it hits 25%. Factories close. Railroads go bankrupt. Tens of thousands of businesses disappear. Homeless encampments spring up in major cities. Breadlines form. Families lose everything. And here's the kicker. It doesn't recover in a year, or 2 years, or 5 years. This depression lasts 23 years. That's right, 23 years. Longer than the Great Depression of the 1930s. Historians call it the Long Depression. And for 2 decades, America struggles to rebuild. Why did it happen? The same reason every crash happens. Too much debt, too much speculation, overbuilding in a single sector. Railroads were the tech stocks of the 1870s. Everyone thought they were a sure bet. Banks lent recklessly. Investors piled in, and when the bubble popped, the entire economy went down with it. Now look at today. Corporate debt in America is at record highs. Entire sectors are over-leveraged. The Federal Reserve is tightening. Interest rates are rising. Credit is getting expensive. And just like in 1873, everyone believes the system is too strong to fail. But 1873 teaches us something critical. America came closer to total collapse in that crash than it did in 2008. And almost nobody today even knows it happened. Crash number 2, the 1929 to 1932 market death spiral. Okay, People know about the Great Depression, but here's what they don't know: how much worse it was than 2008. In 2008, the stock market dropped about 50%. Painful, yes, but it recovered within a few years. In 1929, the market dropped 90%. 90. Imagine that. You had $100,000 in the market. Within 3 years, you have $10,000 and it's not coming back. Not for 25 years, the Dow Jones peaked in September 1929 at 381 points. It didn't return to that level until 1954. That's a quarter century of nothing. An entire generation lost. But it wasn't just stocks, it was everything. 9,000 banks failed in the United States. 9,000. When a bank failed back then, there was no FDIC insurance. Your savings were gone. Breadlines stretched for blocks. Unemployment hit 25%, and that's the official number. The real number was probably higher. Hooverville's shantytowns, named after President Hoover, popped up in every major city. Families were evicted. Farms were foreclosed. The Dust Bowl made it worse. Entire communities disappeared. The middle class was wiped out. And here's what most people don't realize. The government didn't swoop in to save the day immediately. Franklin Roosevelt's New Deal didn't start until 1933, 4 years into the collapse. And even then, recovery was slow, painful, incomplete. It took World War II and the complete mobilization of the economy to finally pull America out. So, why was 1929 so much worse than 2008? Speculation. In the 1920s, people were buying stocks on margin, borrowing up to 90% of the purchase price. When prices started falling, margin calls forced everyone to sell at once. It was a death spiral. Banks were heavily invested in the stock market, so when the market crashed, the banks went down too, and there was no central bank bailout, no quantitative easing, no stimulus checks. The system was left to collapse on its own. Now compare that to today. We have record levels of margin debt again. We have speculative bubbles in tech stocks, meme stocks, crypto. We have an entire generation of retail investors who have never seen a real bear market. And we have a Federal Reserve that has printed so much money that the only way to fight inflation is to raise rates, which pops bubbles, which crashes markets. The pattern is identical. The only difference is we think we're smarter this time. Crash number 3. Japan's 1990 lost decades. This one shocks Americans because Japan was unstoppable. In the 1980s, Japan was the second largest economy in the world. Japanese companies were buying up American real estate. Rockefeller Center, Pebble Beach, Hollywood studios. The Japanese stock market, the Nikkei, was soaring. Real estate in Tokyo was so expensive that the land under the Imperial Palace was worth more than the entire state of California. People believed Japan would overtake the United States, and then, in 1990, it all collapsed. The Nikkei peaked at 38,915 in December 1989. By 2003, it had fallen to 7,600. That's an 80% crash, and it never recovered. As of today, more than 30 years later, the Nikkei still hasn't returned to its 1989 peak. Real estate crashed even harder. In some areas, property values dropped 90%. People who bought at the top were underwater for life. Entire lifetimes of wealth gone. But here's what makes Japan's crash unique. It wasn't a quick collapse followed by a recovery. It was a slow, grinding, multi-decade stagnation. They call it the lost decades, plural. Economic growth flatlined. Deflation set in. The Bank of Japan cut interest rates to zero, then below zero. They printed money, they bought assets. Nothing worked. An entire generation of young Japanese grew up in an economy that never grew. Wages stagnated. Opportunity disappeared. The psychological damage was permanent. Why did it happen? A massive asset bubble fueled by easy credit and speculation. Sound familiar? And here's the warning for America. Japan had a declining birth rate, an aging population, high government debt, corporate zombification. Companies kept alive by cheap credit that should have gone bankrupt. Look at the United States today. Declining birth rates, aging baby boomers, record debt, zombie companies propped up by years of zero interest rates. The parallels are terrifying. And if America follows Japan's path, we're not talking about a crash and recovery. We're talking about decades of stagnation, a lost generation. And no amount of money printing will fix it. Crash number 4, the 1998 LTCM collapse, the crash behind the curtain. Most people have never heard of long-term capital management, but in 1998, this single hedge fund almost destroyed the global financial system. And the fact that it's been memory holed, that it's barely taught, that most Americans don't know it happened, is exactly why it's so dangerous. Here's the story. LTCM was founded by Wall Street legends and Nobel Prize-winning economists. They built a trading strategy based on sophisticated mathematical models. They used massive leverage, borrowing $30 for every $1 they had. At its peak, LTCM controlled over $1 trillion in positions. Then, in August 1998, Russia defaulted on its debt. Markets panicked. LTCM's models didn't account for a Russian default. Their positions collapsed. Within weeks, they lost billions. And because they were so leveraged, because they had borrowed from every major bank on Wall Street, their failure threatened to trigger a chain reaction. If LTCM went down, it would take down every bank that lent to them. And if those banks went down, the entire global financial system could seize up. So what happened? The Federal Reserve stepped in, not publicly, not with a press conference, but in a secret meeting at the New York Fed, they orchestrated a private bailout. 14 banks pooled together $6 billion to keep LTCM afloat. The hedge fund was quietly unwound. The crisis was contained. The public never knew how close we came to total collapse. But here's the lesson. LTCM controlled $1 trillion in the derivatives market in 1998. Today, the global derivatives market is estimated at over $600 trillion. The shadow banking system, the network of hedge funds, private equity firms, and non-bank lenders, is far bigger and far more complex than it was in 1998, and it's far more fragile. If an LTCM-level event happened today, the Fed wouldn't be able to contain it with a quiet bailout. It would be 2008 times 10. And unlike 2008, the Fed has already used up most of its ammunition. Interest rates are still low by historical standards. The balance sheet is bloated. There's less room to maneuver. So when the next crisis hits, and it will, the tools to fight it are weaker, and the system is more fragile. The 1998 LTCM collapse was a warning, and we ignored it. So what do these 4 crashes have in common? Let's break down the pattern. First, excess debt. In 1873, it was railroad debt. In 1929, it was margin debt. In Japan, it was corporate and real estate debt. In 1998, it was derivatives and leverage. And today, the United States has more total debt, government, corporate, household, than at any point in history. Second, speculation. Every crash was preceded by a speculative bubble. Railroads, stocks, real estate, derivatives. And today, we have bubbles everywhere. Tech stocks, crypto, NFTs, meme stocks, real estate. Third, overconfidence. In every case, people believed it was different this time. The economy was too strong, the models were too smart, the government wouldn't let it fail, and every time they were wrong. Fourth, government denial. Leaders always downplay the risk. In 1929, President Hoover said the economy was fundamentally sound. In 2008, Ben Bernanke said subprime was contained. In every crash, the authorities insist everything is fine until it's too late. Fifth, rising interest rates. Tightening credit after a long period of easy money is gasoline on a fire. It exposes all the leverage, all the bad bets, all the zombies, and it triggers the collapse. Sixth, global contagion. None of these crashes stayed local. 1873 spread across Europe. 1929 became worldwide depression. Japan's crash rippled through Asia. LTCM threatened the entire global system. And in today's interconnected world, a crash anywhere can become a crash everywhere. Now, here's the terrifying part. Every single one of these conditions exists in the United States right now. Record debt. Check. Speculation. Check. Overconfidence. Check. Government. Denial. Check. Rising interest rates. Check. Global contagion risk. Check. We are standing at the intersection of all 4 historical crashes. And yet, most people still believe 2008 was the worst it could get. Why could the 2020s be the most volatile decade in U.S. history? Because the system is more fragile than it's ever been. Markets have been artificially propped up by a decade of Federal Reserve intervention. Every time there's a downturn, the Fed prints money, cuts rates, buys assets, and it works for a while, but each intervention makes the next crisis worse. The debt gets bigger. The bubbles get larger. The system gets more unstable. Right now, corporate debt is at all-time highs. Many companies only survive because interest rates have been so low. When rates rise, those companies can't refinance. Bankruptcies spike. Jobs disappear. The economy contracts. Student loan debt is crushing an entire generation. They can't buy homes. They can't start businesses. They can't spend. The housing market is in a bubble again. Prices disconnected from wages, and global trust in the dollar is quietly eroding. Countries are reducing their dollar reserves. Trade deals are being made in other currencies. The BRICS nations are building alternatives. If the dollar loses its reserve status, even partially, the shock to the U.S. economy would be catastrophic. And here's the scariest part. These crises don't announce themselves. They happen suddenly. One day everything seems fine. The next day, a bank fails. A country defaults. A hedge fund blows up. And the contagion spreads faster than anyone can react. So here's the final message. 2008 wasn't the warning. It was the warm-up. The crashes of 1873, 1929, 1990, and 1998 weren't anomalies. They were patterns. And patterns repeat. Not exactly, but close enough. The next crash may not look like 2008. It may look like 1873, a slow, grinding depression that lasts decades. Or 1929, a total market wipeout that destroys a generation of wealth. Or Japan, a lost era of stagnation with no recovery. Or LTCM, a shadow banking collapse that happens so fast the government can't stop it. Or it may be a combination of all four. A perfect storm, and when it comes, it will be worse than 2008, because the system is bigger, faster, more leveraged, more fragile, and more dependent on trust. And trust, once broken, doesn't come back. So pay attention. Watch the debt. Watch the leverage. Watch the speculation. Watch the government's response, because the signs are all there, just like they were in 1873, just like they were in 1929, just like they were in 1990, just like they were in 1998. History doesn't repeat, but it rhymes. And right now, it's rhyming loudly.